Hey everyone, welcome to the Note Investor Podcast. Your host Dan Deppen, and today I'm joined by Jeff Laird, who has a deep background in banking. So Jeff, how you doing?
I'm doing great. How you doing, Dan?
Good, good. Well, thanks for joining today. Maybe we can start by you can talk a little bit about your background and kind of how you found the note industry.
Yeah, I kind of stumbled on it by accident. I got a finance degree at UC Berkeley back in 1980, and I started out working in the banking industry. And I've worked in the credit industry for over 40 years, and I've always thought of myself as being a pretty strong underwriter. I've seen
Hmm.
deals that have gone real well. I've seen bad deals. I understand the documentation process for promissory notes secured by deeds of trust. I'm not real familiar with the mortgage side or the land contract side,
Hmm.
but I got involved years ago with some buddies that were doing hard money lending, and I invested money in a self-directed IRA that way. And
How
we
long
made,
ago was that?
well, that goes back over 25 years ago.
Oh, that's interesting because I don't think many people were doing stuff with self-directed back then. I know they started officially like in the 70s, but you know.
Yeah, there weren't too many custodians that would hold those things for you. So you had to really search. I think Lincoln Financial or something was where mine was back then.
Uh-huh.
Um, and it was my buddies. So when they would show me a deal, most of their investors would pile on right away. I said, no, I want to see the appraisal. I want to do my due diligence, because if this blows up, I still want to be friends. I want it to be my decision, not your decision, to get me into this thing.
Right.
And when I moved to Colorado in '94, I didn't have any connections that were doing hard money lending that I trusted. And so it took me a while to make some connections here locally. But I've invested with a couple of originators out here in hard money loans, and the whole Dodd-Frank stuff screwed up the hard money lending area, where we used to do a lot of owner-occupied stuff because of
Hmm.
consumer disclosures and all that. We started doing just fix and flip and investor stuff, which I think is higher risk.
Sure.
And I stumbled upon a book called "The Number One Real Estate Investment No One Talks About," and this book was written over 20 years ago by Hornwood and Hollingsworth, and it talked about discounted notes. And I go, wow, that's kind of interesting. I mean, the kind of yield you can get on that's pretty good. And back then, I don't think it was very popular. And then I
Hmm.
stumbled upon another book called The Stefanchik Method, and he was talking about partials and all this kind of stuff. I go, this is fascinating stuff. But I could never meet anybody that was doing discount notes. I never ran across anybody doing it.
It
And
was
I knew I
probably
didn't
just
know
Eddie
enough.
Speed down in Texas back at that time.
Probably Fast Eddie, I kind of refer to. But anyway, um, I wanted to learn more about it, but I knew I didn't know enough about it to do it on my own. And so I continued to do the hard money lending stuff. And then I read a book by Martin Sands,
Sands, yeah, that
Sands,
was
Real
actually the
Estate
first
Note
book I
Investing.
read on note investing.
Okay, I read that, and his mentorship was back in Washington, D.C. or back east or something. Never holds them out here in Denver or anything. But
Hmm.
the book was fascinating because it kind of described how to go about doing the business, and then it listed people he had provided mentorships to. And there was some people in Colorado. And then
Hmm.
I kind of did some searches on LinkedIn to find out who was doing discounted notes. I started meeting people like you
Yeah,
in the discount note arena. And it made me a lot more comfortable to be able to talk to people locally that were doing it successfully. And that's how I got kind of interested in it. I said, I would like to do this in my retirement full-time or part-time. I have
mhm,
money. I'm an accredited investor. I have money sitting on the sidelines. I don't want to have it all in the stock market. I kind of like the returns you can get on this. So I dipped my toe in the water with you because you impressed me with the due diligence that you do and your
mhm.
willingness to share that information with your joint venture partner. You made me
Sure.
comfortable. You made me comfortable, Dan. That's what happened.
Oh, thanks. I appreciate that. Yeah, I mean, we've kind of started to develop a little bit of a critical mass with note investing here
Yeah.
in Colorado because, there's other folks like Beth Hale, and there's some other
Mhm.
folks up in Longmont and up in Greeley. So it's become it's not quite like a hub like it is down in Texas or something, but yeah, it's kind of nice. There's a decent, number of folks, and like when Beth runs her meetups and stuff, there's usually a pretty good turnout
Yeah.
out there.
Yeah. So I've educated myself as much as I can by reading books, but now I need to really just get actively involved in it and do it to kind of learn how these things progress. And they're pretty slow paced. I mean, you buy the note, you wait to get the paperwork and documents, then you got to reach out to the borrower. It's not a fast turning investment.
Yeah, that was my struggle when I first started, because I used to do a lot of stock trading and option trading, and I was used to, if I wanted to do something, I clicked a button online and then the trade was on.
Yeah.
Whereas that took me a little while to get used to with notes, because it's kind of slow motion. I've had to take, 2 months to do a loan transfer. It's all
Yeah.
kind of slow motion compared to some other things.
Absolutely. And then I'm kind of cautious by nature. So I know you and I have had these conversations before. When I look at a house in Ohio that's worth $50,000, $60,000, I think, what kind of shack is that? Do I really want to own it? If the borrower
Yeah.
turns the keys over to us, or we have to foreclose upon it, right? I'm
Hmm.
having a hard time getting comfortable with that. But then again, I don't want to throw a couple $100,000 into my first deal. I'd like to learn it at the cheaper deals.
Yeah, I mean, they're relatively small, and some of them, do turn out to be, kind of shacks that
Yeah.
have problems. But a lot of them are actually not too bad overall. There's a lot of areas of the country where just houses don't cost over 100,000, which is hard to wrap my head around, living in a place like Colorado where the values are quite a bit higher.
Right. When I came from California originally, so those
That's
values are
even
even
higher. Yeah.
higher out there. Yeah.
Yeah.
So, I mean, those are my struggles with it. I realized that by buying into one note, I'm rolling dice on that one deal, and if it goes bad, it goes bad, right? So I'm
Yep.
kind of an equity kind of underwriter. That's how I did it with the hard money stuff. I knew there's a ton of equity in there. There's a lot of protection. So if we make mistakes on what we think it's going to cost to do this, there's about a little bit of cushion there.
Yeah, I mean, that's one of the nice things about notes is you can kind of have multiple exits. For me, when I buy non-performing, I don't always do this, but I generally try to buy ones that have signs of life. And when I, buy per my model, I'm getting about 2/3 of them to reperform. And obviously if that happens, then, the deal usually turns out pretty good overall. But, between getting a down payment, collecting 9 or 12 months of payments, and then, the bump in value when you resell the loan. But to your point, yeah, if you've got equity protection behind there, then, you go through the foreclosure process, it's going to take a lot longer. It's going to be expensive, but you can still get a return. So it's kind of like, to me, it's kind of like reminds me of my poker days, right? Where if you, make a big bet, they might fold and you might win, or you might get called and you might still win. So you
Yeah,
kind of have multiple ways. But if things stack up against you, then you can still get bit. There's definitely risk there.
absolutely. Now, I have not yet done anything out here in Colorado, hard money or discount notes through a self-directed IRA. So the
Hmm.
money I'm using right now is just money I have sitting on the side.
Uh-huh.
Ultimately, I'd like to park all that stuff in a tax deferred account. I just haven't gone through the process of setting that up. And I
Hmm.
kind of stumbled upon those IRAs that you can have checkbook writing authority on. Have you ever looked
Yeah,
at any of those?
I've looked at them a little bit. So with my IRA, I've got one at Quest, and they don't do checkbook IRA.
Yeah.
And I went with that because when I set up that account a couple of years ago, that was my first exposure to self-directed IRAs.
Yeah.
And I didn't really know the rules, so I kind of like the idea of not having the checkbook,
Uh-huh.
because they're pretty good at keeping you out of trouble. In the first couple of transactions, you kind of learn the rules, and it's like, well, it has to be this way, it can't be that way. And so that was kind of nice. Now that I'm more comfortable with it, I've considered opening up a checkbook one, but I haven't spent the time yet to do the research to figure out where to go and get it all set up. I've just been doing everything through Quest, and really they've been pretty fast so far. The big issue is funding, right?
Right.
And for me, I've just bought just performing notes and my self-directed. And I've only had one go bad. That'll probably be another podcast at some point when I get that result. That was actually more of a hard money loan
Yeah.
that I made to somebody in Boulder who I'm now foreclosing on, it's a whole ugly thing. Once the dust settles from that one, I'll talk about that probably at another time, but for the most part, I just got performing loans in there. So I'm not really like paying expenses or
Right.
anything. And they've been funding like within about 2-3 business days. So it's worked out okay so far, but I like the idea of being able just to write the check and do things. I think that's kind of nice.
Or even wire the money out the same day if you had to.
Yeah. Yeah. Cause
Yeah.
sometimes, you know, usually note deals, I don't have to be too fast, but there's some opportunities where, yeah, you do have to move a little bit faster. And there are some custodians out there who are nightmares because I've actually dealt with several of the custodians because I've had people fund deals through various ones. And some of them, even ones that I know have done just millions of notes over the years, they act like they've never seen one before. Like they're doing it for the first time. And it's like, I know you guys have done like 1,000 of these probably in the last month. So it
Yeah.
can get kind of frustrating.
Yeah. Yeah. So on the deal that we invested in together,
Mm-hmm.
you mentioned Polaris, which is a credit counseling service
Yeah.
that can. So when they get involved, when you bring them into a deal to try to reach out to the borrower and maybe work out a forbearance agreement or something, do
Yep.
they take into account the borrower's financial situation and how they recommend you structure the forbearance?
They do. So what I really like about Polaris, I'm not even sure if they're taking on new clients. I know at different times they've shut it down, but what I
Hmm.
like about them is they are actually a nonprofit, and so
Right.
they're a nonprofit credit counseling agency. So when they reach out to borrowers, they're I could be misspeaking, but I think they're technically like not a debt collector, so it's a little softer
Yeah.
outreach. And because they are credit counselors, I mean they do their job of credit counseling very well. So they're really good at talking to the borrower, understanding the situation, and then when we come up with these forbearance agreements and trial payment plans, well, I should back up. So kind of the way it starts is they have this onboarding template. I give them all the information on the loan.
Yeah.
And I tell them how I'd like this to go. Like, hey, I just want to focus on cash for keys. I'll offer up to X number of dollars. Or, I'd like, to get this on a forbearance plan and then eventually do a loan mod under these terms. And I'd like to get this much down as a good faith down payment, and then they talk to the borrower and kind of come up, first of all, they find out what's going on if they want to stay or not. And then they come up with an agreement that kind of works for me, but then also that the borrower can perform on, because it doesn't do anybody any good if the borrower agrees to something that they can't follow through
Right.
on. I had a loan a while ago that I had bought, and I inherited a forbearance agreement, and the forbearance payments, it was like 12 payments of like $750 a month, and they weren't coming through on that. And I had Polaris reach out to them, and they got the situation. I said, well, they can't afford that, like not even close. And we came up with another arrangement that worked, and now they've been paying on that
Hmm.
since. So they're pretty good. I like them a lot, and they're also very fast, and they're just very proactive. So if you've ever done these through a loan servicer, I mean any loan servicer, it's just always a big challenge. To do that, they're more expensive. Loan servicers tend to be more expensive. They take a lot more time. I had some loans a while ago at a servicer that was kind of like a full service
Yeah.
servicer. They just do everything. In fact, it's, per their rules, they get real funny, like if you get involved at all. And when I first started leaving loans there, it was kind of great. I'm like, this is good. This is taking some stuff off my plate. They're expensive, but it's kind of like, okay, I'm paying more and they're doing more. But then that soon after kind of stopped, and it got to a point where, they would make one phone call during the month and they go, we didn't get them, and they charge you like $81 for servicing, and they might call them again the next month. So I had some deals that were kind of dragging out and getting expensive. But yeah, Polaris is normally pretty snappy. So I've had a lot of success with them. And for the most part, when we put agreements in place, borrowers have followed through. They don't always follow through. That's the other thing. Sometimes people don't realize. They think just because you get an agreement in place, that means you're done. And that doesn't always quite work out that way. Sometimes they fail on the forbearance. And I had one recently that completed the whole forbearance. We processed the loan mod, and then the dude missed 2 payments. which kind of set me back, right, quite a bit, because you want to show 9, 12 months of payments to sell it as a performing loan. If they pay for a while and then hiccup for a couple months, you're sort of resetting the clock. So that can be frustrating
Yeah.
sometimes dealing with those. So, but so what else? But yeah, but Polaris has been real good. And then, I've kind of found too, and one of the things I'm kind of trying to improve in my processes is keeping the timelines tighter, because it's interesting how things can kind of drag out and you can kind of lose weeks and months
Yeah.
fairly quickly. And that's what I was starting to run into with a couple loans with this other servicer, because I've been doing some look at Excel as I've had some exits recently. One of the things I do when I have an exit is I'll calculate the annualized return to the funding partner, and I'll use the XIRR function in Excel. And, that has a big difference. Just a month here and a month there can make a big difference in someone's annualized return. So I'm trying to optimize that process is pretty key, because if you depend on vendors too much, things can just
Drag out.
really drag out. So
Well, it's good there's organizations like Polaris that actually look at the situation that the borrower has and try to come up with a solution that works for them.
yeah,
That's
they're like,
important.
yeah, and I don't know that much about their background, but from what I understand, they used to do kind of what we do in the
Mhm.
notes business, and they were really good at the borrower outreach, and so at some point decided to just kind of focus on that. And I've learned a lot, working with them, because it's really interesting too, right? When they come back, sometimes they come back and say we agreed to this and it was exactly what I wanted. And then whenever they open the email with, hey, this one's going to be tough, I'm like, uh-oh. Yeah. But it's pretty good too, because they really do kind of look out for everybody's best interest. Like sometimes I've had them come back and go, look, I know you wanted a $1,500 good faith down payment, but here's the situation. I don't think there's any way you can do that, but I think they really want to stay, and I think they're sincere about getting on track. So I think if we put together this agreement with a $500 down payment,
Yeah.
they'll be able to perform on it. And of course, the luxury of buying these things at a relatively high discounts is, I've usually got a lot of room to maneuver. I mean, basically, most any situation, if you buy reasonably okay, if the borrower genuinely wants to stay and is, generating some kind of income, even if it's really small, there's usually room to make a deal, if you're willing to take a haircut on some things, and, the borrower really wants to stay in the home and pay. So, but they don't always work out either. I'm doing well, sometimes they work out in other ways. I'm doing a cash for keys right now. That should be interesting, where the move out is in about a week. And the borrower rented a dumpster and is moving stuff out. So that one's looking good. That was one where I offered the property value was pretty high, and I offered a pretty high cash for keys amount. Sometimes I put that in as an option. Like if they want to do cash for keys, we can do X. And that one, Polaris came back and said they want to do cash for keys and move out. And I was like, whoa, I didn't expect that, because I didn't have a team in the ground on this in this city. So I had to hurry up and get prepared to deal with an REO, which I'm kind of there now, but that one kind of took me by surprise, but hopefully that works out pretty well.
Do you run across many situations where it would just make more sense for the homeowner borrower to just sell the house and move
Yeah.
out?
And they don't. It's weird. It's weird. I had one earlier this year. It was in Cincinnati, and let me get into too long a story, but so I bought this loan actually from somebody that was in Colorado. He was moving back to Texas, and he had a bunch of notes, and he had been doing fix and flips. He had been doing a lot of real estate stuff, and he was putting money in another deal, and he was just selling off his notes. And he said, I just wanted to get my cost basis out of them. So I bought this non-performing note, and then after we closed, he sent me the stuff and said, oh, by the way, I had contacted the borrower. The borrower wanted to stay and agreed to write a new land contract. So in Ohio, if a land contract is over 5 years old, you have to go through the full foreclosure instead of being able to do a forfeiture, which is a lot faster and cheaper. And so he said she made this down payment. We created the new contract for deed, so she knows that if she doesn't perform, it's a relatively faster process to take the house back. It's like a couple months versus maybe like 9 months or a year in Ohio. And she started paying again. I'm like, wow, this is sweet. I just bought a performing loan at a non-performing price. And she paid for a few months and then stopped. And then she was real untrustworthy through the whole process. She said she was sending payments in to Madison, the loan servicer, and that they were losing them, which I've had other borrowers say that to me. I found that's a giant red flag. Whenever a borrower says I sent a payment in and the servicer lost it,
Yeah.
I never get another payment from them. Like usually that's like the end of the road. Like they're not, it's always a dark sign. It seems like when I hear that. And now in Cincinnati, the other wrinkle is some cities, if it's a contract for deed, they want whoever is on title to have their name on the water bill.
Okay.
And so she had also stopped paying the water bill. And I had talked to her on the phone and she was real nice. Oh yeah, I'm going to take care of the water bill. No worries. I'm going to do this. I'm going to do that. I'm like, okay, great. And then she never would.
Yeah.
And then so I started the forfeiture process and she goes, oh no, it's all a misunderstanding. I'll take care of it. And then she never did. And we went through the whole process. She actually called me the day after the hearing, and she was just, when I picked up the phone, I didn't know if she was going to start yelling at me or what, but I figured I should probably answer it because I wanted some information on kind of what her plans were. But she was genuinely surprised that had happened, that the land contract got canceled, which, I mean, on one hand, I don't know how you could be surprised, but I think she genuinely was. And in this situation too, back to your earlier point about do borrowers ever sell the house, she had a lot of equity in this house. She could have sold the house, paid me off, paid the transaction costs, and netted probably $10,000 to $15,000 at the time. But instead, she just kind of rode the ship down. And then at the end, she must have turned the water on for like the last couple of weeks, because I ended up with a $1,500 water bill at the end.
Yeah.
But it was still a home run deal for me and my partner, because she forfeited so much equity. So it was kind of silly. Instead of running a $1,500 water bill, she could have just sold, she could have not done that, sold the house, pocketed a lot of cash. I mean, she could have been paying rent for a year, after that with the cash. Instead, she was just kind of out. So people don't always do what's aligned with their own best interest. They generally do, most of the time, but they can do some crazy stuff. I would say most of the time they do, but not always.
Okay. So you indicated earlier in one of your emails that went out that towards the end of the year is a good time to find bargains because people are trying to clean up their portfolios and they put stuff on the market that might be opportunistic.
Yeah. And last year, and now that I've, the other thing you find too is once you close with sellers and kind of build relationships with them, they'll send you stuff that they know that you'll close on. So sometimes I've increasingly over the last year got more stuff sent to me that people didn't just blast to their entire list. And at the end of last year, it was like right before New Year's, a seller came and said they had this one note. They wanted to get rid of it. They were selling that at a big discount, but I had to close by New Year's. And it didn't give me much time to do due diligence. But I got it done quick. Closed. I just used my own funds and did it. It was a relatively low dollar note. Anyways, but it was a contract for deed that I bought for I think it was like 35 cents on the dollar or something. And it was performing. And it's been performing ever since. So, I mean, I think I bought it. My yield to maturity is like over 30%. It's ridiculous. And then a little while back, I refinanced myself out by selling a partial. So now I've got, basically income coming in for that. and I refinanced myself out, so I don't. Well, I've actually got a little bit of money in it right now, but not very much. So yeah, you do see you can see some good deals at the end of the year. It's always hard to tell how it goes. The first couple weeks of October, so we're recording this October 22nd. It'll come out probably 2 weeks from now. It's been a little bit slow, but actually just this morning, I emailed my big asset manager list, and I got a handful of tapes in today, and I got contacted by some new folks who I hadn't heard of before, so that's kind of exciting too. So yeah, it's kind of the busy season for notes, because I've had a lot of people looking to fund deals that have said, hey, they want to do some stuff before the end of the year. And then there's one guy that said, hey, it's been a few months, you haven't sent me anything, what's going on? He keeps calling me, so I got to find him something quick. Yeah, definitely kind of a busy time of the year. So hopefully we'll see. Hopefully I can pick up a lot of good stuff, but you also kind of want to be careful about it and not just go crazy. Because for me personally, my portfolio is kind of at a decent size right now. So there's no need to go too crazy stretching. My goal is just to kind of try to be opportunistic and just pick stuff up that's on sale. Because the other thing that happens too at the end of the year is you see a lot of the junk that's been sent out throughout the year gets recycled.
Okay.
So a lot of the stuff, at least last year, a lot of the stuff I saw at the end of the year was stuff that I had seen like 5 other times that year and was super junky. So you got to be careful too. A lot of times people are, putting out their nastiest stuff as well.
Okay. Buyer beware, huh?
Oh, always in notes, right? I mean, it's definitely the Wild West. I was talking to a family member a while back, and they asked me, is there? I forget exactly how they asked it, but is this clear through someone? Is this kind of like regulated? I'm like, no, there's no, it's not like bowling with bumpers. It's you do have to be careful, right? Because people will try to sell crappy stuff and not disclose really bad flaws, and everything else. So yeah, you got to kind of be stringent on your due diligence, and there's some advantages to being able to move fast sometimes, but you don't ever want to move too fast to where you screw something up. So
yeah, that was one of my big challenges in trying to dip my foot in the water. I would go to some of the websites, like the old FCI, I think it was called.
Yeah, they changed the website. It's still around. I forget what they call it now, but yeah.
It is. And I mean, a lot of that stuff didn't look like it was much of a good deal when you look at the actual return on your investment and the amount of work it would take. And I talked to some people that actually have bought some notes off of FCI, and they said, well, you never offer what they're asking. You lowball them by about this much, and then you start doing your due diligence,
Yeah, so, it's funny. There's a lot of stuff on there that just never trades. I've never actually bought one from there. But what's weird too is, you do run into this where there are a lot of, what's interesting about pricing in notes is there's almost no like set market pricing. There's no Amazon of notes.
Yeah.
And I've picked up call them like similar quality notes at radically different prices at different times. And some sellers do ask for and hold the line on wanting like really insanely high pricing that nobody ever pays. So a lot of stuff doesn't trade. So it's kind of a weird market. It's not as liquid as it should be. And I'm not sure kind of why that is, but just across the board, whether it's on, a particular website or somewhere else, there's often a disconnect between buyers and sellers that I don't quite understand. Because especially in the contract for deed world, they've got a pretty good handle on what they can be bought for and what they tend to trade for. And I'm a little surprised that more stuff doesn't trade. Some of it is borrowers being or sellers being too proud of their stuff. And so, like, I've seen people wanting like 90 cents on the dollar for stuff. And the other thing that's funny is a lot of sellers have a very loose interpretation of like quote unquote performing. Like that's always funny what some people call performing.
Yeah.
And at the same time, though, it's interesting as I've been in the process of selling some of my reperforming notes. So some of these ones that I bought non-performing that we did do some of those forbearance agreements with Polaris and got them paying again and processed loan mods. A lot of buyers are also overly skittish, and I get a lot of really low ball bids as well. So it's interesting on both ends, but kind of over time you kind of find your sort of go-to sellers and build a network of other note investors. A lot of times note investors will trade with each other at various points, and you kind of get it figured out over time.
Well,
There's definitely a lot of friction in the market.
Well, it makes sense to me. I mean, once you've established yourself with those people that are marketing notes, and they know what your criteria are, then they know you're going to buy it and you're going to actually close if you say you're interested and the due diligence checks out.
And that's huge, right? So like when I started, a lot of sellers, and this is for people who are listening who haven't gotten really started yet, but when I started and I was reaching out to sellers, a lot of them were just very standoffish, and I got kind of offended by it. I'm like, well, I don't get it, right? I mean, in any other facet of life, if somebody's selling something and I have money and want to buy, we can work stuff out, right? Whether it's a house or car, something on Amazon, whatever. And I didn't get it at all. But then when I started doing more selling myself, and you start running into a lot of really flaky borrowers who end up not closing. And then it dawned on me, oh, that's why they're so standoffish when they run into somebody that's brand new, because they're trying to figure out if there's somebody that's going to be just real flaky and get back out of everything and never ever close. Or they also worry about people being joker brokers,
right?
Getting a hold of their tape and blasting it out all over the place. But yeah, if you can develop a reputation for closing, that's huge. That's why sometimes I'll get stuff sent directly to me, because if it's something they know it's in my wheelhouse, and they know that I'll tell them, even if it's something I'm not interested, I'll come back and tell them. That's the other thing a lot of people don't do that I think is a good idea is, if you're not going to bid something, just let the seller know. Like say, hey, these are all in New York and New Jersey. I don't buy there.
Right.
I like to buy in Michigan, Indiana, and Ohio. Let me know if you have anything there. That kind of helps.
Well, I know I felt really bad on the first deal you and I looked at together, because I backed out of that one, if you recall, because the broker price opinion came in much lower than what we had thought it was going to.
Yep.
And like I said, I'm an equity guy, and you didn't give me a hard time, which I really appreciated, but I felt bad. I thought, well, Dan probably won't let me look at any more deals, because I said,
well,
yeah,
no,
I like this
okay.
one, and I said, I don't like it anymore.
Yeah, no. I mean, but that was okay, because we had talked about what an equity guy you were beforehand.
Yeah.
And it was very clear about kind of what your criteria were and what you were looking for, and then, why you backed out, and I had, backup for that anyways. So, so it wasn't a big deal. So we kind of said, okay, I'll go find one that fits your criteria better, and then that's kind of ultimately what we did. So yeah, there's there's that difference between, it's like canceling bids and stuff. I do that all the time when I find problems in due diligence, and then I just go back to the seller and say, hey, here's what I found. And if it, like I've bid on a lot of stuff where I get bids accepted and I find out the property's trashed and vacant when they had listed it as owner occupied.
Yeah.
And I just send and say, hey, I got to cancel this one, and here's why. And I send them the photos, and that's never really an issue. I've only ever had one seller get mad at me for that, and that was a guy that I didn't really want to work with anyway. So that was okay in that case. So, well, very good. Well, hey, I think that's probably a pretty good stopping point.
Yeah.
For right now. So we'll kind of wrap up the podcast recording. So, hey, thanks so much for joining. Really appreciate it.
And thank you, Dan.
All right. We'll talk to you next time.